Amazon posted over $600 billion in revenue in 2025. But behind this massive number lies a growing concern. AWS growth is slowing, consumer demand is flattening, and margins are under pressure. So the big question is Amazon still a smart investment, or are cracks starting to show in the foundation? Let's break it down. Welcome to Marketlands, where we deliver expert-level analysis on NASDAQ, S&P 500, and crypto markets. If you're serious about building a strong investment strategy, make sure to subscribe and turn on notifications. Let's start with the income statement. In Q2 2025, Amazon reported total revenues of around $600 billion, up 9% year-over-year. That sounds healthy, but AWS, the crown jewel of Amazon's business, only grew by 14%. Just 2 years ago, AWS was growing at 28%. This decline is worrying, especially considering that AWS contributes the bulk of Amazon's profits. Slowing growth in its most profitable segment could signal deeper structural challenges. Looking at the margins, gross margin remained relatively stable at around 45%. However, operating margin dropped from 6% to 4.7%, largely due to increased logistics costs and heavy capital spending. Amazon has been pouring billions into its prime delivery infrastructure, including warehouse automation, drone delivery systems, and AI optimization. While these investments may pay off long-term, they're currently putting pressure on near-term cash flow. Speaking of cash flow, Amazon generated approximately $25 billion in free cash flow in the first half of 2025, a solid figure. But the company's long-term debt has ballooned to $75 billion. With interest rates still elevated, the cost of servicing this debt is rising. Amazon's net debt to EBITDA ratio currently stands at around 1.9x, manageable, but starting to look stretched in a tighter monetary environment. Now, let's look at segment performance. E-commerce still makes up the bulk of Amazon's revenue, but it operates on razor-thin margins. AWS, as we mentioned, is the profit engine, but it's slowing. The dark horse here is Amazon's advertising business, which hit $55 billion in 2025. That puts Amazon in direct competition with Meta and Google, and it's a high-margin, fast-growing revenue stream that investors should watch closely. From a valuation standpoint, Amazon stock is trading at around $185 as of July 2025. That gives it a forward P/E ratio of approximately 48, significantly higher than the S&P 500 average. Clearly, the market is still pricing in strong growth, but with AWS slowing and global consumer demand uncertain, that premium valuation carries risk. Now, let's talk about the big picture, the risks. Amazon faces a range of macro and structural challenges: global economic slowdown, regulatory scrutiny in the US and EU, rising labor costs, and growing competition in cloud services. Microsoft Azure and Google Cloud are both gaining ground. If Amazon can't maintain cloud leadership, its profit margins could erode further. So is Amazon still a buy? If you're investing with a 3 to 5 year horizon and are willing to tolerate short-term volatility, Amazon still has. If you're investing with a 3 to 5 year horizon and are willing to tolerate short-term volatility, Amazon still has strong fundamentals, diversified revenue, global infrastructure, and dominance in key markets. However, at current price levels, it may not offer the best risk or reward ratio unless there's a pullback. In short, Amazon is still a giant, but even giants slow down. Investors should focus less on top-line revenue and more on efficiency, profitability, and future innovation. Thanks for watching. If you found this breakdown helpful, hit the like button and subscribe for more professional-level financial insights. See you in the next video.